Hi guys, welcome to part 2 of ethics for CFA level 1. In the last part we covered various discussions about what ethics are, some basics about why do we need them. Then we covered the PCB program and how exactly the investigation it starts, how it is conducted, what all decisions can be done, the redressal mechanism, and we also discussed the code of ethics. We ended the previous session with first standard out of the 7 standards that we have in our ethics content. So let's start right away with the next part, which is second set of standards, which is integrity of capital markets. Now, integrity of capital markets has only two subparts, first of which is the material non-public information. Now, before we discuss the content or the language of the standard, let's quickly go over this entire terminology. So I'm going to split this name into two parts. First of which is material. When exactly would I consider an information to be material? There are two ways of judging that. You can use either of those. First is if any information has the possibility of affecting the value of a security in the market. So let's say there's a particular company whose share is listed in the market. If any information has the potential to change that value in the market, then I would call that particular piece of information as material. So any information that can influence the price or the value of any security, that is considered as material. The other way of looking at it is if a rational investor, now the term rational investor is going to appear a lot of times throughout the CFA curriculum. What it simply means is an investor who is capable of taking an informed decision. So someone who is aware of the markets, aware of how the markets function, someone who can take an informed decision. So that type of an investor, before he makes an investment decision, if he thinks he should have a particular piece of information, then that piece of information would be classified as material. So any information that a rational investor believes he should have before he makes the decision whether to invest or not, that piece of information can also be thought of as material. So two ways to look at it. One is whether it would influence the price or not, and the other is whether a rational investor would want it before making a decision or not. You can think of material information in either lines. Both would be good for your exam. Next is non-public information. Now, generally, we have a lot of information in the market which we call public. Public information simply means anything that is accessible and available to the public at large. So you can access it and use that information. You can access it using the public domains. For example, Apple company stock is listed on the stock exchange. If I want details about their financials, I can get that information from the stock exchange itself. So that stock exchange information is public domain. Anyone in the general public can access it. So that is what I have for public information. So non-public information simply means an information that is limited only to a few individuals. Only a few people know about it, not the general public at large. So I'm talking about information which only a few people know, but it is very important. Now that we know what material non-public information means, let's look at the language of the standard. So members or candidates who possess material non-publication information, so members or candidates who possess this kind of very important sensitive information that is not there in the public domain yet, they must not act or cause others to act on it. So you should not be taking any actions based on that information, and you should also not influence or cause someone else to take actions on that. Now, as far as this language goes, there is one inherent complication here. What if I get that information in course of my normal business? Now, as a CFA professional in the future, you might have a case where you're working with the clients, and at times you will be receiving some sort of material information from the client in order to make sure that you're able to work properly. And that information could also be non-public. So the institute is clearly clarifying that if you receive material non-public information in course of your genuine work, in course of your legitimate work, then so long as you use that information for its intended purpose, you are not in violation of the standard. So when it says you must not act on it, it is not prohibiting you from using that information for its intended purpose, provided you have been given that information by the company itself over the course of your normal work. So let's say I do some sort of investment reporting or valuation reporting, and the company provides me some information. In that case, using it just for the report that I'm supposed to prepare, that much is fine. That would not violate the standard. What would violate the standard is if I decide to use that information for any other purpose. So using material non-public information received in course of normal work for its intended purpose, not a violation of the standard. Now, another thing to note here is that it is, at the end of the day, a member or candidate's responsibility to find out whether any information that he is using, is it public or not. So at the end of the day, the responsibility of checking whether that information or any information that you are using as a member or candidate, has it been actually released to the public or not. So you cannot simply claim that you were not aware whether it is public or not. It is your responsibility to make sure that information you are using is public information. Now, one specific case, or rather there can be different cases, is that this standard has a violation only if you use non-public information which is material. What if I use non-public information which is non-material? Not a violation of the standard. What if I use material information which is public? Again, not a violation of the standard. So aside from these two, any other combination of information you could get, it is acceptable. One particular case that is given specifically by your institute is known as mosaic theory. Now, mosaic theory is talking about a specific case where I decide to combine non-material information along with public information. So let's just write it in some sort of an equation. So what exactly could this be? Well, one of the basic examples is, let's say you are out on a lunch or a dinner and you see two company CEOs at random, sitting together having dinner. Generally, this is not a material information. It makes no difference for me as an investor to know where a particular company CEO goes to have a dinner. Not relevant. So it is non-material. But next day, I decide to go and look at those companies whose CEOs were there. I look at those companies' balance sheets, income statement, financials. What I find out is one company has a lot of cash sitting idle and the other might need some sort of funding. So what I've done is I've combined non-material information, two CEOs having dinner together, and I've combined it with public information, their financials which are available in the public domain itself. If I use these to make some sort of analysis and to come to a conclusion, make a decision, and then give my recommendation to my clients and make some investment actions, that again will not be a violation of the standard. So as I've said before, only material plus non-public, that is what the standard is covering. Any other combination would not be a violation of the standard. So that completes standard 2A. Now let's move on to 2B. Now, standard 2B is talking about market manipulation. The standard is relatively straightforward, and so is the language. In fact, this language is exactly what is given in the Code of Ethics and the Standards Handbook, which I have linked in the description. That handbook is the official language as given by the CFA Institute. You can refer that as well. So let's go straight into the language. So members and candidates must not engage in practices that distort price or artificially inflate trading volume with the intent to mislead market participants. Now, there are two major parts of this statement. First is practices that distort price or inflate trading volume. Now, this could be anything. It could be general trades that I place, which could end up impacting the price. Let's say a security normally has a trading volume of 1 million shares. If all of a sudden someone places a request for 5 million shares, that would have a very high impact on the demand supply balance of that security. And as such, demand would be higher than supply, and that would have an eventual impact on the prices. Now, similarly, I can also make an order where I decide to buy 5 million shares of a share of a company, and I also decide to sell 5 million shares of a company. Now, generally, it is balancing the demand supply outright, so I might not have as much impact on the price, but all of a sudden, the market looking at the trade might feel that there is a lot of buying and selling happening in this security. So now I am trying to inflate the trading volume. Now, either of these two acts, they can either be done with the intent to mislead the market participants, which is what the second part is saying. So if there is the intent to mislead, then it would be a violation of the standard market manipulation. Now, in the real world, there is a possibility of having trades which are genuine but might still end up inflating the trading volume or distorting the price, which is why the second part of the standard says there has to be an intent to mislead. So, if the trade is genuine and it affects the price or the volume, because my intention was not to mislead the participants but rather execute my own genuine trade to make sure I buy some particular investment that I'm interested in, then it won't violate the standard. The key word here is the intention to mislead. Now, the intent to mislead could be explained by a basic example. Let's say I have to buy a security. Now, if you want to buy a security, you generally want to buy it at a lower price. Anything that is at a discount, you feel you've got more value out of it. So, if the share price is very high, what I can do is I can spread false rumors about the fact that company is going bankrupt. Those false rumors would end up affecting the price. It might bring the price down, which is when I might place my buy orders to buy a lot of shares. And I would get those shares at a very low price. Now, in this case, the false information that I have spread, its intention was to mislead the market participants. There might actually not be any sort of bankruptcy happening. I have just misled other market participants to make sure I had some benefit in this trade. So, distorting price or inflating volume with the intent to mislead others, that is when the violation happens. So both the conditions, when they are met together, that is when the standard is violated. Other than that, any genuine transaction that distorts prices or trading volume, that is fine. So that's all the discussion about standard 2B, market manipulation. Let's move on to the next set of standards, standard 3, which is duties to clients. So guys, the next set of standards we have, standard 3, is about duty to client. So these standards are basically setting a precedence as to what an entire ethical behavior or a framework of moral behaviors would be for all of our interactions with the clients. So the first one that we have, 3A, is a very basic standard. It is simply a sort of an introductory standard to all the other substandards that we'll be covering within duties to clients. So let's quickly go over it. 3A is loyalty, prudence, and care. Now, as the naming suggests, it is in general suggesting that you are supposed to be loyal to the customer, loyal to your clients. Make sure every decision you make is prudent. It uses some sort of conservatism. Don't take rash decisions because you are taking decisions on the behalf of your client. And lastly, you should exercise reasonable care, something that we've covered in the Code of Ethics as well. So let's quickly go over the standard itself. Members and candidates have a duty of loyalty to client and must act with reasonable care and exercise prudent judgment. So very basic. Then you should always act for the benefit of client. Again, a basic. The third statement is a little bit more important. So client interest comes before the interest of employer or your own personal interest. Now this is talking about a specific case where, let's say, once you clear some of the exams, you are in the job, you are working out there, you might have a situation where you are supposed to decide as to whether to take an action which is good for the client or to take an action which is good for your employer or to take an action which is good for you. So whenever you have these choices and these actions conflict with each other, the standard is simply saying the first priority always goes to the client. So in any case where you have some sort of conflict as to what you should be doing when all the possible actions are conflicting with each other, your simple choice is do the action or take the choice which is most beneficial for the client. So client comes first. Now, aside from this, there is one specific case which has been discussed in a little bit more detail within the standard 3A. That is talking about proxies. Now, what exactly are proxies? Well, there might be situations where some of us might be working as, investment managers, wealth managers, portfolio managers, where basically we are managing the funds on behalf of our clients. Now, normally, if you own a share of a company, you get the voting rights. So let's say, I own some shares of Google. When Google has its general meeting, I will have the voting rights to be able to cast my vote to decide what decisions would be taken at general meeting. Now, normally when we have an investment manager, the shares are owned by the client himself, but all the actions about those shares are handled by the manager. In such a case, even the voting at times could be done by the manager on behalf of the client. So when the manager is participating in the act of voting on AGM matters, on behalf of the shareholder, on behalf of his client, that is known as proxy. Now, with regard to proxies, the institute is focusing on one particular term, and that is that with regards to proxies, you as an investment manager or portfolio manager or wealth manager, you are supposed to act in a responsible manner. Now, if let's say I am voting on behalf of the client on a proxy, as a proxy, I can take a decision which I believe is correct, so long as I have a reasonable justification for it. At no point is the standard saying that my decision has to be 100% same as the decision that client would have taken had he casted the vote himself. Now, it is possible that the vote cast by the investment manager is different than the vote that would have been casted if the voting was handled by the client himself, by the shareholder himself. Now, Institute is not marking this particular situation as a violation of the standard. So long as you, as an investment manager or a professional, have taken a very responsible decision where you've done your analysis and you have acted in the benefit of client, if you have a justification for the vote that you have cast, then you are in compliance with the standard. So at no point is the standard saying decision has to be same as what the client would have taken. It is simply saying that you have to vote proxies in a responsible manner. Another thing about proxies is it is often possible that at times the matters that have to be voted on are very menial. And as such, the analysis to see what decision should be taken in those cases could involve more cost than the benefit that the shareholder would receive. So in that case, standard is also saying that it is not necessary to vote on all proxies. So in case there is some sort of cost benefit constraint, you don't have to vote on certain proxies. So voting on proxies is not a necessity. Now, aside from this, one other thing that the institute mentions is that any sort of client brokerage, commission, or soft dollars that is received should be used to benefit the client again. One basic example could be that you get some client brokerage on a particular client who is investing in, let's say, equity shares. Now, from that brokerage, I decide to buy access to Bloomberg's database so that I can further enhance my analysis that I use on equity shares for the benefit of that client. This is exactly what the standard is recommending. If you use the client brokerage for the eventual benefit of the client himself, then you would be in full compliance of this standard. So that is all the discussion about standard 3A. Now let's move on to 3B. The next standard we have is 3B, which is talking about fair dealing. So let's quickly go over the language of the standard and then we'll discuss some nuances. So members and candidates are supposed to deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, taking investment actions, and any other professional activity. So basically, in all sort of your professional activities, you are supposed to deal with clients fairly and objectively. So two keywords: fairly and objectively. Fairly simply means that you are not supposed to take any action or do something that puts a particular set of clients at some sort of a disadvantage compared to other clients. Now, an important thing to note here is fair is not the same thing as equal. And the standard is using the term fairly and not equally. So there can be differences between the services you offer to different types of clients, or rather, to clarify further, service tiers are allowed. So what I can do is, let's take an example. The best example I can think of is Netflix. Now, Netflix has different price points at which you could subscribe to their content. But the content you get access to is more or less the same. The difference mostly lies in the quality at which that content would be delivered. So, as such, if a new show releases, all the Netflix subscribers get access to it on the first day itself. So, no particular set of Netflix subscribers are at some sort of a disadvantage in terms of content that is available to them. Similar thing is allowed for us to do as well. I can have multiple service tiers, two, three, or different categories of my clients. Let's say, for the sake of simplicity and the example, let's take two service tiers. One is my basic, and the other is, let's say, a premium service tier. What I normally do is, whenever I have some investment analysis or some recommendation to communicate, I do it at the same time for all the clients, irrespective of what service tier they are part of. But for those who are part of the premium tier, I offer an additional benefit where, if they want, we would be having a one-on-one session where I would interact with them to further discuss the analysis. Now, this further discussion of analysis is not necessarily putting the other set of clients, the normal clients, at any sort of disadvantage, because if I'm disseminating the information at the same time, all sets of clients that I have, be it basic or premium, they all have equal opportunity to act on it. The violation of this standard would be a case where I simply say that premium clients would get the information 1 week in advance. That would create a disadvantage for the other set of clients. So the key thing is, you have to deal fairly, which means you are not supposed to put any particular group of clients at a disadvantage over the others. You can give some additional services, some additional benefits to a particular set of clients, that is acceptable. Also, service tiers have to be disclosed beforehand to all clients. So all clients must also be aware that the service tiers exist. So I cannot have a service tier called premium if the basic service tier clients are not disclosed that there exists another service tier as well. So basically, it is saying that every client, if he wishes, should be able to join the premium tier as well. Again, let me clarify, no discrimination should be done that would disadvantage any particular set of clients. So that is fairly. The next keyword is objectively. Objectively is simply saying, don't let any sort of personal biases or any other biases influence your decision making for that client. If two clients have similar risk return profiles, similar expectations from their portfolio, you should be able to get to similar conclusions for both the clients. Don't let personal biases influence your decision that you are taking for the benefit of the clients. So, you're supposed to deal fairly and objectively with all clients. One small thing that Institute is also covering under 3B is the case where, at times in my professional life, I might be in a position where I am involved in the entire IPO process, the initial public offering. If I decide to allot shares on some sort of preferential basis rather than on fair and proportionate basis, then also I'd be in a violation of standard 3B, fair dealing. So that completes 3B. Let's move on to the next one. The next standard we have is 3C, which is suitability. Now, the actual text for this standard is very long, very bulky, a lot of details in it. So if you want to go over the entire text, you can check the handbook that I have linked in the video description, or you can even refer to your ebooks. How we are going to discuss the standard is by creating a flowchart so that you guys have an easy work when you want to revise this concept. So this standard is talking about how my interactions or my recommendations or actions that I take as far as investments are concerned on behalf of my clients, how they have to be suitable for the clients. So the details of the standard are split into two parts, which is basically how your relation can be with the client. So generally, our professional relation with the client can be categorized in two ways. One is the advisory relation, and the other is the relation as a portfolio manager. So let's discuss the advisory relation first. Advisory relation simply means that my interactions with client or my responsibility towards the client is to simply give him recommendations as to what securities, what investments I believe are going to be suitable for my investment. Whether the investor decides to act on it or not, that is entirely his responsibility. So the responsibility for action lies with the clients. My responsibility is to only give advice. Now, in advisory relation, we have three elements given within this standard. So first one is to make a reasonable inquiry. Reasonable inquiry into what? Well, reasonable inquiry into all the information about the customer or the client that you may feel is necessary for you to be able to give them some sort of recommendations. Now, before we discuss the details, let's quickly look over something known as IPS. IPS stands for Investment Policy Statement. It is basically a document in which I like to create an entire investment profile of my client. So I would look at what his return expectations are, what are his risk capabilities are there any sort of constraints? I could have tax considerations to consider with regard to any particular client. I could also have cases where maybe the client has some major expense coming up in the next 2 or 3 years. So that creates a liquidity need that I would need. So I would look at all the relevant constraints and I would create an entire risk return profile of my client. That profile is known as IPS. The actual details of how it is to be constructed, the format, everything, all of that is part of CFA level 3 curriculum. So at level 1, simply be aware that this is basically the initial document that I create, which contains the entire profile of the client. Now, the first part, reasonable inquiry, is saying that in your interaction with the client, generally it is the first interaction before I have given any sort of advice or recommendation, anything. So, in that first interaction, I'm supposed to make a reasonable inquiry into all the matters that I believe would help me to construct a very good IPS. So that would include inquiry into what the investor's expectations are, what his past investment experience is, what are his risk parameters, like what are his liquidity needs, does he have any major expense coming up. We could have a client who's, let's say, 30 years old and he has a child who's 2 years old. So he might have to plan for the college fees of that child over, let's say, next 15 years. So I have to now create a portfolio or now give my recommendations on such a basis that after 15 years, when he needs that money for his child's education, he should be able to withdraw the same from his investment accounts. Similarly, I can have another client who maybe wants to buy a house in 2 years. So I need to now create an investment portfolio, or rather give my advice for creating an investment portfolio such that the client is able to withdraw the relevant money after 2 years to buy that home. The key thing to note here is that the word is reasonable. So at no point does the institute or the standard require you to make an absolute inquiry. So if the client decides to keep some information away from you, you will not be held responsible for the impact it has on his investment profile. So once you've made a reasonable inquiry, once you've constructed a very good IPS, after that, the next part is to recommend some investments to my client. So once we've created an IPS, made a reasonable inquiry, made a very good IPS, the next step of the process is to give some suitable recommendations to the client. Now, this is where the word suitable is relevant. My recommendations have to be suitable in context of the IPS that I've created. So let's say, I have a particular security which is very risky. I will not be recommending that security to an investment client who has very low risk tolerance, who is not able to take too much risk, who probably wants to create an investment for his pension, which he might start needing in 10 years. I would generally not recommend him to invest his money in those high risk securities. So my recommendations have to be suitable in context of the risk return profile of the investor. Aside from this, there is one other suitability that I have to check. Aside from this, I'm also supposed to check whether the investment recommendations I am giving are they suitable in context of total portfolio or not. For example, let's say I had a very long discussion with the client, created an IPS, and in order to match the investments to his risk return profile, the investment decision that was recommended is that he makes 30% of his account investments in, let's say, real estate. Now, maybe he already owns a home, so that is already putting his investment in real estate somewhere about, let's say, 35%. If I start recommending him more and more real estate securities that individually are suitable for his IPS. So again, individually, the securities I am recommending are suitable for his risk return profile. But if he actually decides to act on them, they would create a big imbalance in his total portfolio where real estate would all of a sudden become overweight. So my responsibility as an advisor in an advisory relation is to make sure I'm making a reasonable inquiry, I'm suggesting suitable recommendations based on the IPS, based on the risk return profile of the investor, and I'm also checking whether those investments are suitable in context of his total portfolio as well. So that is all about advisory relation. The other possible relation is that of a portfolio manager. Now, the other possible relation is where I am supposed to not only recommend and do the analysis work, but I'm also supposed to take the actions on behalf of the client. So basically, buying and selling of securities, that is also now my responsibility. In an advisory relation, my responsibility was to recommend, to give advice. Whether the client follows it or not, that is his discretion. But in this case, I'm supposed to take actions on behalf of the client as well. So in this case, the standard is very straightforward. It is simply saying, follow whatever mandate you have agreed upon with the client in the initial interactions. Mandate again would refer to the IPS itself. So generally in portfolio management, client and the manager agree on some sort of terms and conditions that this is how all the investment actions are supposed to be dealt with. So in case of suitability as a portfolio manager, you are simply supposed to follow whatever terms and conditions have been agreed upon in the mandate with the client beforehand. So simply follow the mandate. So that is more or less the content of standard 3C suitability. There is one major complication which is involved in case of standard 3C. Let's look over that. The one major complication in standard 3C is about unsolicited trade request. Now in real world, there can be cases where a client comes to me as an investment manager with a specific demand to buy a particular security or to make a particular investment on his behalf. Now, when I as an investment manager know that that investment or security is not very suitable for his profile, for his risk return profile, in that case, I am stuck between a dilemma whether I do what the client wants so that I can retain him as a client? Otherwise, he's probably going to go with some other investment manager. Or do I follow the 100% moral code and simply deny his request to make sure that till the end I am acting for the benefit of the client? Now, such trade requests are known as unsolicited trade requests. And to deal with it, there are certain recommendations that have been given. So the first criteria for dealing with it is to classify whether such request has a major impact on the client's overall portfolio or not. So two classifications of these requests: minor and major. Now, mind you, this classification is on the basis of the impact these trade requests would have on the client's overall portfolio if they were executed. So, in case I believe that the request that client is placing, it would have only a minor impact on his risk return profile. It won't change the dynamics of his portfolio all of a sudden. In that case, generally, I can follow my firm's policy as to how I'm supposed to deal with these issues. Now, the firm's policy could range from being something very minor where the firm simply says that you are allowed to execute a trade to a certain percentage. So let's say the client came to me with the intention of investing $10,000, and the firm policy says that okay, you can invest 80% of that, so that client is also more or less happy, and it dilutes the impact on the portfolio as well. So I'd invest $8,000. Firm policy could also be something where I am requested to, where I create some sort of a separate account to handle all of these requests that have risk return characteristics which are very different from the risk return characteristic of the investment itself. Now, the firm policy could range all the way up to creating a separate account to handle all of these requests so that the main client account has its own risk return profile and the separate account has its own risk return profile. So you can follow whatever your firm's policy is on that. Now, in case I conclude that this unsolicited trade request has a major impact on my client's portfolio, it is going to drastically change the risk return dynamics of my investment portfolio, there are certain steps to be followed. So firstly, I would want to update the IPS itself. Take a cut for that sound error. So the first step is to discuss with the client to maybe update the IPS, maybe create a whole new IPS which has a new risk return profile for the client. That would allow me to now be able to execute this trade request on behalf of the client. Now, there can be a case where the client accepts this updated IPS, in which case, problem solved. But there can also be a case where the client does not accept this updated IPS. If the client does not accept this updated IPS, again, your solution is to follow whatever your firm's policy is. Again, firm policy could range all the way up to creating a separate account to handle these requests. Now, one thing which is common, whether I as an investment manager deem this request to be minor or major in terms of impact it has, one thing that is common between both of them is client discussion. So in either of the cases, before executing on the trade request, before taking action on the request that the client has made, I am supposed to discuss with the client as to why that investment is unsuitable for his overall IPS, for his overall investment portfolio. I'm supposed to have a written acknowledgement from the client that yes, we had this meeting where we had discussed why a particular trade request is unsuitable for his given portfolio. So this part is going to be common, whether it's a minor impact request or a major impact request. So this completes standard 3C, a very big standard. Let's move on to the next one. So the next standard we have is 3D, which is performance presentation. So specifically talking about any sort of information that you give to your client with regards to the performance of the investment account. So the standard is simply saying you are supposed to take reasonable efforts to ensure that performance information is fair, accurate, and complete. Now, one of the key words here is accurate. This is to make sure that there are no sort of misstatements when I'm providing performance presentation. I don't want there to be mistakes or there to be information which is not 100% correct. Also, another keyword is complete. This is saying that all the information that I have should be reported. I'm not supposed to hide any particular fact. Now, one complication that arises from completeness is that I might have cases where, I'm just giving a brief presentation. If I give everyone in the audience, the 100-page giant research analysis report, that is not really going to be very well. So standard realizes this sort of a complication, and the way out is very simple. When concerned about reports and some brief presentations, we are allowed to give some summary information to make sure our presentations are precise. But full and detailed information, the complete information, should also be available on request in case any audience member demands it. In fact, it is generally a good practice to simply tell everyone that in case they want full information, the same is also available. So you need to make sure that in case anyone requires all the relevant information, the same is made available to them immediately. So you can use brief presentations, but even in those, the availability of full and complete information should be there. The last case is talking about past performance. Now, at times there is a case where people try to represent that okay, in the past we got 10% return. If somehow you're trying to imply using that 10% that you can maintain that 10% return in the future as well, that would be a violation of the standard as well. So simply reporting past performance is fine, no violation, but implying the ability to achieve what you have achieved in the past, that is a violation of the standard. So very small standard that completes 3D. Let's move on to the next one. So guys, the last standard that we have in standard 3 is 3E, which is preservation of confidentiality. Now in general, whenever you're dealing with clients, clients would often share their very sensitive, very relevant information with you. This standard in general is simply saying that you are not supposed to disclose that information out in the public. You're not supposed to disclose that information to any outsider. So any information that you receive in a client and managerial interaction, that cannot be disclosed to the outsiders. So let's go over the standards. So keep information about past, current, and potential clients confidential. Mind you, over here, it is talking about past clients. So even the ones who are not currently my clients, but I've served them in the past and their information is available with me, that information as well I'm supposed to keep confidential. Current clients are obviously part of this. Also potential clients or prospective clients. So these are basically people who are not currently my clients, but in the future they might become my clients. So maybe I just had an initial meeting with someone who hasn't yet signed me on as their investment manager, but they might have shared some information with me. They are not my client right now, but they are my potential or a prospective client. So that information that such a client has shared with me, even that has to be kept confidential. Now we have three exceptions where basically you can disclose the information. And if you disclose the information, you would not be in a violation of the standard. So those three conditions are basically when there is some sort of illegal activity involved on the part of client, of course. So let's say, somehow the information I have is that the client, the money he is wanting to invest, he has basically robbed a bank. Now, in that case, I have a legal complication as well. I might have legal responsibility to report the same. But the standard is saying in case there is illegal activities on part of the client, me disclosing that information to the outside public or to the outside authorities, is not going to violate the standard. I am allowed to disclose information in such a case. The other case is when the same is required by the law. So let's say there is some regulatory filing in which I have to disclose certain details. In that case as well, I can disclose the relevant details as required by the law without violating the standard. Lastly, I have a case where disclosure of information is permitted by the client himself. So the client himself just gives me a written permission that, okay, if you want, you can use this information, you can disclose it to other people. So these are the cases about preservation of confidentiality. One particular case that the institute is focusing on with regards to this is, well, in the first session, we went over the PCP process, inquiry, then investigation. Let's say in an investigation, you've been called up to share information. Now, the institute is saying in that sort of an investigation, you cannot deny from cooperating with the staff by citing this. So basically, the institute is saying, don't try to act smart with us. You will be required to disclose all relevant information if it is part of some sort of a PCP investigation process. So you can't simply deny your cooperation in that investigation process by saying, well, I'm preserving the confidentiality of my clients. No. So that concludes the entire standard 3. Now let's move on to standard 4. So guys, the next set of standards we have is standard 4, which is talking about duties to employers. Now, if you've been following the trend that we've been having in the past few standards and code of ethics, we've had duties towards profession, which is basically, we need to protect the integrity of the profession. Then we had the same thing about capital markets. Then we had our duties towards the clients. And now finally, we have duties towards employers. So we can actually form a sequence. At the topmost priority comes the profession and the market. After that, we have client. Then we have employer. And after the employer, well, it's you and me, all of us. So any sort of personal interest that you might have, that is to be given last priority. Now, with that out of the way, let's look at standard 4A, which is loyalty. So just like we had 3A, which was just giving a basic idea as to what all our duties to clients are, this is also just giving us a basic outlook as to how our interaction with our employers are supposed to be. So let's quickly go over the language. So we are supposed to act for the benefit of the employer and not deprive the employer of the advantage of skills and abilities. So basically any sort of skills, any sort of abilities that I have, I should not be depriving the benefit of those to my employer. So, you're studying CFA, once you get a job, or maybe if you already have a job, once you clear the CFA exam, the additional skills and knowledge that you have now, you cannot deprive the benefit of those to your employer. Then we must not divulge any sort of confidential information or cause any harm to the employer. So again, not divulging confidential information. The information specific to clients was covered in standard 3, which was preservation of confidentiality. This is talking specifically about any other information that you have about your employer or any information that you've acquired during the course of your employment. So both of those are covered here. Now, aside from this basic language of the standard, there are several, minor complications that may arise. So let's, quickly discuss them over. Firstly, while the standard is talking about employers, this standard would also be applicable to people who are working as an independent contractor. So if you're working on an independent contract, even then you will be governed by the provisions of this standard. Then the next thing we have is talking about personal obligations. So at no point is the standard saying that you are supposed to completely ignore your personal obligations. It is simply saying your personal interest as far as investment action and professional activities goes, that is supposed to take a second priority over the interest of employer. In fact, the standard isn't setting some sort of a line beyond which you are not supposed to take care of your personal obligations. So it is not setting some sort of a threshold. Rather, the standard is clearly just mentioning that, if there is some possible conflict between your personal obligations and your employee duties, you should agree and discuss all of that with your employer beforehand. So now, one other complication that we have with regards to the standard is independent practice. Now, there can be situations where, someone is working as an employee in a firm, but after they return from their job, They might also, be helping a few friends, families, friends of friends with some sort of investment analysis, investment recommendations. And at times they could even charge some amount for that. In that case, this entire act of, providing services outside your employment is what we call independent practice. Now, it is generally allowed. There is no such violation here. The only thing standard is imposing is you, as a member or a candidate, have the responsibility to make sure that you disclose to your employer the fact that you are carrying on an independent practice. So if you have made the relevant disclosures, simply having an independent practice has no violation of the standard. Another sort of complication we have with the standard is in connection with resignation. Normally we have some sort of notice period. So standard is clearly clarifying that this standard should continue to be applicable till the date your resignation comes to effect. So simply giving a resignation letter doesn't absolve you from the standard. Rather, this standard is talking about your employment. So long as you are an employee, whether you are in the notice period or not, the standard applies to you. Now, the next bit of complication comes from the fact that there can be situations where a member or a candidate is changing employments. Now, let's say I've decided to change jobs. Firstly, I cannot take any sort of information with me which I had received simply because I was in employment. So let's say I was working with a particular client, and I have numbers of that client's CEOs and managing directors. Now, those contact details of the CEO, managing directors, those are not available in the public domain, which means that I had access to that contact information only and only because of my employment. Now, this is the kind of information that I cannot use with my new employer. So if I change jobs and I go to the new employer and I still want to, somehow interact with the old client, maybe get their business back in, provided there is no violation of the employer contract, of course. In that case, the standard is simply saying that knowing that a client exists is not a violation of the standard. In fact, if you use publicly available information to reconnect with your client, then also you will not be in an outright violation of the standard. Using the information that you had access to simply because of your past employment, such as contact details of CEO or managing director or financial manager himself, that is the information that you are not supposed to use. If you use that information to reconnect with the client, then you will be in an outright violation of the standard. So it is clearly saying, if knowing that a client exists or a potential client exists, not a violation of the standard. Using public information to reconnect with the client, again not a violation. But using information that you had access to in the first place only because of your employment, that would be a violation. Now, two other complications that the standard is further clarifying. One of them pertains to the fact that, let's say I did some act which is not beneficial for the employer. Now, there are certain exceptions where such an act would not constitute a violation of the standard. Firstly, I'm doing this for the benefit of the client, or I'm doing this to uphold the integrity of the market or the profession. So, either of those cases, if I am doing something that is not for the benefit of the employer, I would not be in violation of the standard. Also, any sort of knowledge or experience that you've gained with your past employer, you can use it at your new employer without it being a violation of the standard. So, let's say you have 3 years of work experience of financial analysis. You can use that 3 years of experience in your new job as well. So simply using your knowledge and experience that you've gained on the job, on the employment, somewhere else or with the new employer would not be a violation of the standard. Another thing that you need to look out for is that when you resign from a job, when you're leaving the employment, you should comply with all the relevant policies that your employer had with regards to you leaving your job. So it could, pertain with how you're handling your social media interactions, how you will be dealing with the clients, how you will be handing over the clients to someone else who would be replacing you. So all of those policies as well, you should be in compliance with to be compliant with this standard. So that was basics about what the standard for duty to employer would incorporate, and particularly standard for a loyalty. Now let's move on to the next standard. So the next standard that we have is 4B, which is additional compensation agreements. Now, generally, when we are in some sort of an employment, Our major source of compensation is the salary that the employer is paying to the employee for his services. Additional compensation agreement is talking about anything additional that the employee might be receiving from any outside source, aside from the salary that he is drawing from the employer. So the standard is simply saying do not accept any gift, benefit, compensation, or consideration that competes or might reasonably be expected to compete with the employer's interest. So if you receive any payment from the outside that is conflicting with the salary itself. So let's put it in a more simple terms. The salary that the employer is paying you, he's paying that so that you provide the employer the benefit of all your skills. And if you end up receiving payment from outside, that ends up creating a scenario where you are no longer able to give the full benefit of your skills to your employer. That outside payment would then end up interfering or rather conflicting with the salary that you are drawing from the employer. That is the case of additional compensation agreement. And in general, the standard is simply saying you should not be accepting any such payments. Now, there is one exception to this general rule. That exception is talking about a case where I, as an employee, might be getting some additional compensation agreement, and I have also disclosed the same to the employer, and the employer himself has also agreed to that additional compensation. So, in case I have some sort of an additional compensation agreement and all the parties involved are fully disclosed about the facts and consent to that particular arrangement, in that case, this arrangement would not constitute a violation of the standard. Mind you, when the standard says the word compensation or consideration, it includes both direct and indirect. So if I receive the payment directly, then that is a direct compensation. If let's say someone else, maybe my friend receives it and then my friend pays it to me. In that case also, while my friend is the person who has received the compensation, the beneficial owner of that compensation would still be me. And in this case, the compensation is indirectly tied to me. So when the standard is saying compensation, gift, benefit, consideration, it is talking about both direct and indirect. So that completes standard 4B. Now let's move on to 4C. The last standard that we have out of standard 4 is 4C, which is responsibility of supervisors. So basically, this is talking about specific cases where you're studying for CFA. After you accumulate a few years of experience, you might find yourself in a position where not only are you doing financial analysis research work, but you're also leading a team of analysts. So you are not just there to do the analysis, you're also there to lead a team. You are going to supervise a team. In that supervisory position, what all responsibilities do you have? That is what this standard is covering. So let's quickly go over the content. The standard requires you to take reasonable efforts, the key word being reasonable. So you're not supposed to have 100% absolute efforts. There is no benchmark for what would constitute as absolute efforts. If in your professional opinion you believe you have taken all the good steps, that is what reasonable efforts means. So take reasonable efforts to ensure that others subject to supervision and authority. So basically, any sort of subordinates or juniors that you have when you are in a supervisory position, this is talking about to make sure that all of them comply with applicable laws, rules, regulations, code, and standards. So basically, laws, rules, regulations applicable to your activities, plus code and standards. Make sure all of your juniors, all of your subordinates, all of them are complying with all of these. Now, an important thing to note here is that at no point does the standard require for those people who are subject to your supervision, your juniors or subordinates, at no point does the standard require them to be members or candidates of the institute. So this standard is going to apply on all of the people who are subject to your supervision, irrespective of whether or not they are members or candidates of CFA Institute or not. So even if you have someone who has no connection with finance whatsoever, but he is working under your supervision, in that case also you're supposed to make sure that he is also complying with all laws, rules, regulations, codes, and standards. Now the standard also throws one complication towards you, which is what are you supposed to do in case you believe that the company's internal control system is not adequate? So internal control is basically company's internal mechanisms to detect, are there any sort of violations of ethical standards, code of conduct, or any sort of law, rule, regulation. So companies' internal mechanism to detect if their operations are complying with everything. So if you believe that that internal control itself is not adequate, the standard simply requires you to try to suggest changes to your supervisors or to whoever is in charge of handling those internal control operations. Try suggesting changes to get that internal control system upgraded. Now, if you believe that the internal control system is not adequate, or rather it doesn't exist at all, the standard also requires that you do not accept any supervisory roles so long as that deficiency of internal control persists. So as long as there is no or inadequate internal control, you should not be accepting any sort of responsibility, or rather any sort of supervisory role. One other thing that the standard is putting out clearly is that in case anyone subject to supervision does in fact fail to comply with any law, rule, regulation, or code, or anything of that matter, in that case, the standard requires you as a supervisor to be prompt with your actions. So you have to take corrective actions promptly, whether that corrective action simply involves making some corrections in the analysis, or it involves imposing some sort of penalty on the wrongdoer. So that completes 4C, and with that, standard 4 is done.